Hi everyone, another day at the Fun Factory. I hope you're all doing well. So weekly preview and market chit chatter for week commencing 17th of June. How is everyone getting on today? It's a bit of a dull follow through from what was going on last week, isn't it? Haven't received the preview back yet, I don't think. So I'll send it this afternoon, but I'll just chat through it and show what I've put in there. So is this working for everyone today? Hello? Has anybody got anything to ask on chat before we crack on? See there are a few of you in there. Rusith Manisha, low sound. Um, is that better? I think the YouTube might have been muted. Rusith? I think that's working better now. So there was mute on certain things. So how are we all? How are we getting on? The central bank's 85% ownership of gold rule with reference to yeah, is the most important for gold, probably a lot of the missing on. So you're probably aware of lots of regulations over the years called Basel 1, 2, and the last one was 3. My mic is on maximum, guys, so I'm not quite sure. There's a mixture of people who are getting it fine and some that aren't. I don't know if you, at your end, if there's some kind of YouTube issue. But I'm running on maximum on just about everything I've got. So yeah, you'll find it's probably your end somehow. Anyway, back to that question. Basel 3 brought in the whole fact of they're trying to stop runs on asset classes, i.e., when you got the whole situation with the subprime crisis and not having control and people not having ownership of the underlying assets. They wanted to change that to make sure that anybody that had asset backing of anything needs to own lots of it, and particularly if you're the lender of last resort and you're the central bank, then what's backing you needs to be something substantial. So what they've done is they've allowed gold to become the second asset class that can be deemed to be reserve assets. So lots of people had just the dollar, and that's what happened out in Asia, etc. For a long time. China and Japan had massive holdings of treasuries, and they've been selling them down, mainly into buying gold. And the main reason why they're doing that is the rules under Basel III is that you can count gold as a reserve asset status as long as you physically have access to 85% of your holding. Now, prior to this coming, you didn't have to you could hold your gold and you didn't have to physically have it in your country or in your central bank or within any of the vaults around the world with an attached claim. But now you do. And that came into action at the start of January 23. It had been formulated in the mid-teens, 2013-15. It got delayed for various reasons, and then COVID delayed it. Now, during that period, the Bank of International Settlements, who actually actions this, they were running not necessarily naked short, but certainly a short position in gold. And when they were implementing the rules, they've closed out their short position because they pretty much understood what was going to happen. And that was that there'd be a scramble in for two things. People who own gold would need to suddenly back it, and then there was suddenly a reason why you would want to own gold in preference to this permanently devaluing dollar around the world. So you now got a form of money asset class that actually has a physical element to it and can't be repeatedly diminished in value. So you've got to physically own 85% of that, and that's causing lots of issues. So around that new all-time high in December, and then the subsequent sideways pattern, a lot of the selling that tried to get that back down through 2000 was running into people with physical settlement actual purchases. Now, remember, we've talked about this before, but so like 95% of all gold trade prior to that always took place in paper. Very little of it actually got moved around. It's very difficult to store, etc. And there's all sorts of arcane rules you've got to get through. But now there's certainly for the central banks, you've got the ability to move it and hold it, and they've got a fundamental settlement reason to do so. Then they are settling in physical gold. Now, what's going on is that it's been well known over the years. Various large banks have worked as agents for the Fed. They've often been big sellers to try and keep the overall price idea of gold and inflation pretty much subdued. And there's all sorts goes on. You may want to go into the settlement issues and the data available at the COMEX and the London bullion market, but often so much of it takes place in off-the-counter contracts, over-the-counter contracts, OCC or OTC, that you don't necessarily get to see what the full picture is. But within that, and the people, clever people like Andrew Maguire, is on YouTube, has been a whistleblower of everything that's gone on down there. He's been in front of the Treasury Committee. He's recommended to the FCA sorting things out about all this crazy stuff. And now that the BIS have put this in place, then there are some gargantuan positions. Now, trying to knock gold down to levels you want is all well and good if you're hitting paper buyers of gold and people who are happy to settle in cash. But if you suddenly hit someone that wants gold, you've got to find that gold. Now, we've shown before there's not enough really being settled, that being produced or mined on a yearly basis or found. This is a whole idea why we're in super cycle, in order to satisfy any kind of decent percentage uplift in settlement in gold. And that is what was happening with the central banks. So just a year's mining would take up a lot of the demand for, I think we showed it as 1 or 2% difference in settlement relative to paper transactions. So if anyone gets short of this and hasn't got the ability to find the gold or have the gold to, or borrow the gold to lend out, etc., has got to go and physically buy it. Now, we know what the situation is geopolitically. We know that the majority of gold is over in Asia. Anything that's produced in China stays there. Blah, blah, blah. Yeah, a number of people, Ben, have said some say it's good, some say it's not. I'm not quite sure why. I've rebooted. Everything is loud at this end in terms of volume. Definitely in that. So hopefully that demonstrates to you that if someone needs to go and buy it, it all depends on someone physically wanting to sell it. So you can find paper sellers left, right, and center who will sell you a financial contract in gold. But if you want to go and buy it, then it all depends what price it is for actual physical delivery, and that could well be a couple of $100 higher, if not more, for large quantities. Pierre French. I don't really know what we're going to do about that because the volume is on max. Is that any better? YouTube. What's YouTube volume? YouTube volume is max. Boom, boom, boom. How many people can hear it okay? Just bear with me then. I'll try and just exit and come back and see if it makes any difference. Thank you, Brooke, Frank. I will just restart. So don't go away. I'll be back in a minute. Right, hi, I'm back. Does that make any difference? Rena, thank you, TJ. So on that gold situation, do you understand that there's gold, and then there's gold? And it's now that the rules have changed for settlement purposes and for holding for central banks, then there's a massive demand for gold that just isn't there. So sooner or later, people are either going to do what they're doing at the moment, and that is keep buying it, or they will chase it in gold physical form. That is the one of the first stages of what the BRICS are going to do with revaluing it, etc. But as things stand at the moment, what happened at the end of May when we weren't sure where we were in that consolidation pattern, and we had the breakout, and we thought there was that low quality finish, and we'll show that on demonstrate it makes sense on the chart. Yeah, so remember, you can see this chart, can't you? Yeah, perfect. So gold chart, just going back to the all-time high, which is put in as a wave 3 here. There's a minute wave 3. We've done the 5 down. We did what turns out to be now a double consolidation. We had this weak 5 low end. I keep talking about it, and then this bit here, the move, start of June, was some people really panicking about gold settlement, apparently, because there'd been a sell-off into the end of May. And then they knew, apparently, the Fed are aware of the non-farm payroll, and they are supposedly short amongst all this complex situation. They used the China release of not having official reserves going up and the non-farm payroll to smash this down in a 5 wave right to a new low for the move. Now that is right now, that low hasn't been taken out, so that there's 2 things from that. That gives us a valid finish because that's a 78.6 of the original 5 down, so it's a valid finish. But also, it's below 2,300, and there's lots of chatter that there's big orders in physical gold sat down there. So they've already hit through some in this region here, 2,300, etc. And that's why we've had this move up, and we haven't penetrated back down yet. Now, there could be an attempt. We think 2250 was supposed to be where this whole pattern would finish, but it's seemingly running into people in here. Now, if you remember when we moved up in in January, February, after we'd had that new high, let's just go back to 6 months. So original high to 2150, and we meandered sideways. There was a big attempt to get this thing down through 2000, and that apparently ran into a big buyer in gold form, in physical form, after which we started to get these big repeating impulses all the way up to the all-time high that we were talking about and set up for. So it seemingly seems to be the reason why everyone was looking at this and going, it's ridiculous, there's no breathing points. The classic impulsive breakouts. But a lot of it has come down to the fact that people were getting short physical gold, and because it had never really been a problem in the past and they could settle easily, people are now literally insisting on being settled in gold. If you don't own that, don't have access to it, you've got to go and find it. So that is what we're up against now. So we've got to try and adjust for allowing within our models for why these things can suddenly break out and why they might get hit down. So if China had eased back on their buying once we'd hit this all-time high, I said all this selling was just hitting paper sellers in the main. But I'd said originally when this path was going, when we talked about over here when China apparently had stopped, we only found out about it in here, is that they would probably try and let the whole thing play out in the classic form to try and get people short at the lower end. Well, it sounds like they've picked 2300 and below as the area. So we need to keep that in mind. And there's up to 2 weeks left for this to play out. So it's not saying it's going to go straight away today, but be aware that sometime in this next 2 weeks, someone's got to find a lot of gold. So into this period here, there's probably going to be a proper panic. The only way out of that is you've got to be able to find an actual producer or a holder to potentially lend it to you. And again, good luck with that, because why would you if you're expecting much higher prices? So, and also within the system, anybody that is aware of this is going to want to buy the gold for themselves, aren't they? So that just makes the supply even shorter. So this is coming home to roost in gold, pretty much what happens in other deliverable, consumable futures, like as in agricultures and oil, etc., where things can suddenly get manipulated when physical delivery actually takes place. Cool. So hopefully that's thoroughly covered that one. Any other questions on that? Donald Ballaghan, very good question. Most of physical gold in the world is in the US. Well, it seems that most of it is actually now in China, and there is actual doubts about America's reserve in the vaults. There's rumours that a lot of that has been loaned out at times. And when Germany asked for their gold back 10 years ago, they couldn't find it. They actually gave them lower quality, had to give them more of a lower quality gold. So let's have a look at a few questions that are coming up. Some people who've done a lot of the adding up of where stuff's gone have got China having access to about 36,000 tons of gold, whereas America's supposed to have 8,000. China only looks like it has 2,500 as their physical assets. But remember, they told everyone to start buying it in 2000s. They've been importing it like crazy. They've got lots of government agencies that don't count in the official numbers that buy it, and all of their produced supply stays at home. They don't export anything. So seemingly, and they've done surveys in China, and they've had something like 96% commitment that if the government were to do anything, people would commit their gold to whatever the policy is. Whereas in the US, everyone distrusts the government and the Fed completely. Would private gold step in and help? Very unlikely. Would companies? Again, depends who owns them. What else have we got? But Frank, if people can't find the physical gold and supply remains short, what is the expectation on the price? Well, it goes through the roof. You actually physically have to go to where you can find it. If you default on that, big penalties, and no one's out. It's going to make the market go mental. It's going to make you fall out of the game. And if you're still short, at some point you have got to close that. So this is what they call literally a short squeeze. The last thing you want to do is, if you're short, is show that you can't deliver it. So there'll be lots of shenanigans going on, trying to suppress the price with paper transactions while you're trying to bluff people out of the physical. But while people are aware, the people who hold it are kind of aware this is going on, why would you give it away for free or cheaply? So you're going to wait, which is why most of the investment bank projections are in the 2,500 to 3,000 area for the end of the year. And JP Morgan, remember, they keep going. They're one of the biggest agents for the Fed and are often short. They've been going on about black swan events and the fact that they've also got the low stock predictions, the lowest of all stock market predictions. So they know something weird is about to happen in the next 6 months. We're not talking conspiracy theories here. These are all things that we've been talking about. We know in October, the BRICS market are going to update us at their conference. They're probably going to get their currency up and running in September. So in the next 3 months, there's going to be some strange events going on. And if they're going to revalue gold, then they're going to push the demand relative to supply through the roof, aren't they? I would have thought. So this is literally, yeah. So despite China saying they're probably telling the truth. We haven't been buying it for our asset reserve account, but they probably have been the main buyer amongst other people of all other physicals through whatever agent they use. Am I short or long? Well, yeah, I'm long gold. Um, I'm long leverage gold, and I'm long actual gold company that has got piles of stuff to be cleaned up. That is massively undervalued. Fulcrum Metals. So I'm playing it from two ways there. I'm expecting, like I say, and I'm doing it from the technical aspect. Before we even factor all this in, I still think that obviously we're in this fourth wave of 5-minute waves up to the minor wave 3. So we're still within the middle of the working structure of a bunch of the 3, 4, 5s from our nesting idea. So all this has been done on previous stuff, but we've 1s and 2s we're building for ages, and then we started breaking out. We're still right in the middle of all that breaking out. Fulcrum Metals, I mentioned it, FMET. It's mentioned in a number of my weeklies and presentations from a few months ago. FMET, well worth looking at. Massively undervalued. Niche H, think people don't follow their own rules of their own plans makes it harder to follow market rules in general. Is that in terms of trading? Then not really sure what you're asking there, but Chris Bruce, is a final date for gold contracts. Normally, there's various parts of the month that you can deliver, but the final day is, it's the final available trading day, I presume, of that month. So you're trading in May, you'll be trading in the June contract, which is what was happening in the end of trying to sell it off in the end of May, etc. And then they had another go in the first week of June when they knew they got a few more weeks to sort it out. Ramesses, I'd love it to go to 2250. There's every chance if the buyers move out of the way, but the ones that are stood in the way are asking for physical. So anyone that's trying to get those out of the way ultimately has to deliver that gold. And seemingly, it depends what contract they're trading in, June or July, but at some point they're going to have to deliver that. Donald Ballaghan, when the demand for contracts outweighs the supply of the physical product, is that bullish or bearish? Well, that is massively bullish. So that in any case, if the paper contracts or demand is bigger than the paper supply, it's going to go up. But if physical is involved in it at all, then it's going to just turbocharge whatever the move is. Volume is low, and there's a reason for that, isn't there? Because as we keep saying, people in the know are pretty aware of what's likely to start happening here. You're not going to get too short if you think there's a squeeze coming. The relative downside to upside here is quite huge now. We're talking there are technical reasons to buy it at 2250. There are technically fundamental reasons, as we just described, with the gold supply. And in the super cycle situation and wave setup and certain other setups, we're right in the middle of a breakout as it is. And the super cycle idea is that you can't get enough supply online quick enough to meet the demand. And now, obviously, since BIS implemented the right rules, there's just a generational change. Historically, when people were on the gold standard, they used to own 70 to 80% of their assets would be in gold, and that dropped all the way down to sort of 10% when it was no longer required, blah, blah, blah. Now, all of a sudden, that's suddenly become a precursor to a gold standard. Just by proxy, if people want to be involved in gold as a central bank, you now physically have to hold it. That's a kind of gold standard light. And then you've got people talking about a BRICS currency having a hard element to it. It's not rocket science. This whole thing is out there in black and white, and all the dots are kind of joining up, aren't they? So price prediction for the end of the week, it's difficult, isn't it? Like I said, it all depends on the motivations. If if they try, they might have one more go at trying to bash this down, but at the moment it seems to be holding the current lows. But I think it'll be forlorn if you smash it down. You're not going to get any physical sellers, so you're just building up the gearing that you're short of. I don't think it's a sensible move. Sooner or later, whether it's this contract or another contract on a further month out or 2 months out, this thing's going to have to correct properly, which is one of the reasons why we are going to keep getting these all-time highs. And I think we're moving into the action phase of this. So just be aware. This is something to be really aware of. As a day trader, bullish or bearish, I think you've just got to look for the right entries. But I'm trying to explain to you why there's going to be crazy volatility that you don't understand on the day. It's just an overriding filling in the gaps for you for why things have been moving how they have been recently within what we expected to be a consolidation phase, and then having odd finishes to it. Well, hopefully that's helping you, but you certainly don't have to trade on a daily basis on the back of this or scared of it. You just need to be aware of it when things move and certain momentum comes into it, that you've got a starting point, that you know what's going on, and you probably want to get on the back of the momentum. So yes, that is correct, Donald. That is correct. Every time the contracts expire, the physical product is needed, can't be delivered. It creates volatility. So yeah, that's seemingly what's been happening ever since this started happening in January, February, where people kept trying to force the price back down. There was a lot of toing and froing with the inflation figures and the dollar, etc., and it was being used as a way of getting hit. China was a massive buyer alongside other central banks, and they asked for delivery, and that's what started causing the panic. Buys through the roof to get hold of the physical. Now this game's getting more advanced. People are starting to believe in much higher prices. So 3,000 looks like something that is going to happen at some point. It's just how we get there. So we went into that a little bit earlier than I expected, but that hopefully has covered gold for today. Then, yeah, I mean, within here, this structure could easily just keep going upwards and sideways in a sort of nesting idea for breakout. At the moment, it's important that you hold the A low over here, which is that 2280 odd print, isn't it? So 2286.50 is important. That needs to hold to stop, to prevent the thing going to 2250. But I'd be amazed if there's much volume occurring to try and make that happen. There'll be a scramble going on for the next couple of weeks, probably, to get back paper shorts in and around here. So we just need to see how it reacts when we're in that space. There's a lot of very supportive areas. What's going on there? Right, any other questions on gold? And obviously, if once we start it believing it's breaking out, silver's at such an advanced stage as well. That is, anyone that's been playing it, as we keep suggesting, is doing well on up days, because it is outperforming the gold moves. That is again in short supply. China starting to corner it for solar panels, and mega in demand for other industrial uses and for weapons. So that is in an advanced stage of a breakout. We showed that cup and handle a few weeks ago. That has got a sort of 6-month mega breakout ahead, really, to finish that off. Brooke Frank, do we have an indication of what the major support level is? Yeah, that 2286, I think, and 2250 is the bottom of the trend line of that whole ABC correction, and is where the 100-day moving average meets. So I'd have thought 2250 is quite important, but I'd be amazed if the buyers don't demand gold delivery. Don't quite understand why they'd hold back on that. But so they've basically got the market cornered. They can do whatever they want. Any questions on anything else? Right, let's just quickly go back to the preview for when it does come out. All right, I'll send that out afterwards. It has arrived. So I got a question from one of the people on my chat this morning, just saying, why was the CAC down 3% at the end of the week, and it was down 6% over the whole of last week? Does everyone understand what's going on in Europe and France in particular? So you'll see me chat about the global trader Luke, L-U-C, and he's the law of unintended consequences. And when it happens to be his cousin in France, I call him Jean-Luc. And he certainly popped up last week in the form of Emmanuel Macron. Complete plonker. What on earth was that all about? We talked about last week, the arrogance of trying to fight off the losses in the European Parliament by calling a snap election. So if you've been keeping up with it, France have just recently seen their debt downgraded by the rating agencies. The ECB have been all over them to try and get their metrics into line, because ever since the euro started, France has mainly been breaking the rules. And this was a real point of consternation throughout the great crash of 2008, etc., because all the pigs, Portugal, Italy, Ireland, Greece, and Spain, were getting smashed left, right, and centre and pilloried for having terrible metrics, and yet France was telling them off, and yet really they should have been in the same basket. But because they were buddying up to Germany, they got away with it. But things have changed in the next best part of 20 years, and now they're on the hook. So the last thing you want to do is just have got everything seemingly under control, the path towards fiscal rectitude, fiscal matters in line, and then the only people that could kibosh that are the left parties with crazy spending plans, and Le Pen's lot, who equally have a growth strategy and a path. Well, in fact, I think both of them have got a path for leaving the euro effectively. So why on earth would you invite that on? So it's pretty arrogant that you thought you were going to be supported. And as it's shown, look, Macron is in a proper mess. So the bonds in France got hammered last week, and there was outflows from the French markets too, equity markets. Now, there's been a bit of change in rhetoric over the weekend with Le Pen, who obviously has nearly got in a couple of times, spotting the fact that this is one not to miss. Is saying that she doesn't want to change institutions, doesn't want to be at odds with Macron if she wins. They'll find a way of working together just to try and appease the markets. But she's still asking for fiscal control. Well, that will continue to scare the markets a little bit. So hence we haven't fully really bounced today. We keep trying to break out and then slipping back. So it might be like that for a little bit more. It's brilliant because it's putting in the end patterns for a lot of the consolidations we've been talking about in the European indices. And it put a bit of a spook into things in general. We just saw flights to quality. That again showed up in gold as well as this technical setup we've been talking about. And then obviously the yen should have got smashed a lot more than it did. But you had flows into Swiss franc and yen out of the euro, to the extent that we're now possibly expecting a Swiss bank cut this week. Their inflation was in line. They have talked about previously, if the Swiss franc gets too low against the euro and starts importing inflation, then they go in and start buying the Swiss franc. I think those two aren't mutually exclusive, i.e. they can both happen. So I think the natural rate for interest rates for inflation is 0, is what they've said. I think we'll continue moving towards that. And if they do get issues with weak currency, they'll start buying it in the market. So they're going to keep doing both sides of their equation until they get to where they want to be. So there's a good chance they can cut this week. We've also got the Bank of England. Now again, the inflation figures were coming down, but not by as much. As we know, Sunak and Hunt had decided that was going to be the day on the lowest inflation print of the year that they were going to call the election by surprise, without telling half their party. So it did come off, but not as much as the market expected. So it was a bad day to do it, really. And they picked a day which confirmed that possibly the Bank of England weren't going to cut rates, and by putting the election in the way, possibly wouldn't. But in the meantime, a lot of the housing data has deteriorated massively in the UK, and the house price index is all the activity data is flat, if not unexpectedly negative. So there's every chance that the Bank of England in discussions will chat about having to keep the economy bobbing along rather than letting it completely deteriorate before they do anything. Are they politically handcuffed? Well, if Labour is far ahead in the polls as they're supposed to be, then they're not necessarily helping anyone, are they? It's hardly a boost enough to get the Tories back in from the mess that they're in. So they can look at it in an apolitical way. And the setup looks like it's nowhere near at 7-2, but two people actually voted cut. Ramsden joins Dingra last month. Now we know that Bailey wants to cut. He's just sitting on the sidelines at the moment. He gets the casting vote. So you only need to get, we know that there are 4 sort of semi-hawkish, definitely unchanged. So you just need to get the other 2 to move, one of which is his economist. That might be the difficult part. But if they were to get to 4-all on the vote, then Bailey would go and make it 5-4 for a cut. So 7-2 isn't as far a jump as what a lot of people are describing. It's still an outsider, but just be aware that there is still a reasonable chance that they may cut rates on Thursday. Everyone okay with that? Anyone got any questions? You've all gone very quiet. I don't understand. And is my volume still okay? All good, Bruce. Someone's there. Thank you, Chris. Are you okay with? Are you all okay then with how Europe is set up at the moment? And the other thing is, France have been told by the ECB they won't be bailed out. As an individual country, they'll just have to live with whatever they end up with. So they will get punished massively in the markets if they don't sort things out. And the irony that I put in the preview is that you've now got the left and right of France. You've got Labour over here, all pushing for uncosted growth policies, which apparently is exactly what Liz Truss was trying to do, and yet she's totally pilloried, and everyone else, it's seemingly a policy you can do. So it all seems to depend on who your media and strategist people are as to what you get away with, because the way that Truss and Kamikaze tried to do that policy is the questionable bit, not the actual growth policy with supply side measures. I think it's terrible for the media to carry on, keep associating this with some kind of crazy Trussism when it's just generally an accepted way of trying to grow an economy. Yes, there are risks to it and it will create more boom and bust, but if you're already bust, some people think it's worth trying to go down the growth side. And funnily enough, Donald Trump has presented a similar idea with his whole corporation tax cuts and using the China tariffs, etc. His economists, it's all another way of trying to grow out of a problem. I mean, over there, it's far too big alone to try and do that. But it just shows you that politics, as radical as it's going, all seems to be behind this same kind of economic mantra. Julian, I've not really talked about Elliott waves yet. I'll go over it a little bit later. We'll really have to build it up in small stages, but I just want to talk about just basic impulse waves and how the counter trend ones, just so that you can get a feel for where you are when you're looking at a chart and trying to look at it in terms of waves. And we'll do that in a bit. I'm just going through the bits of the preview. We talked about the gold setup that we've been talking about on the chat. So yeah, so the combination of the euro and goal and the FOMC fudge, which I still think is crazy, and yet you've got Kashkari out over the weekend, giving it the big one on the media. The media have got it right. It's only one cut, and it'll be at the back of the year. Totally crazy how they're interpreting the inflation data and the slowdown hidden within. And that non-farm payroll to me still crazy. You have to look at non-seasonally adjusted and seasonally adjusted at the same time. They're going to look like real chumps if that gets revised down on a seasonal adjustment next month. So yeah, all very crazy. And Powell certainly wasn't happy about it. He's been quite kind to them the way that he's talked about. They didn't really have the ability to change their dots so late in the day. All it tells you is that he's one of the youngest, Kashkari, on the Fed, so he's got the potential longest tenure there. He's obviously bidding to try and become the next chair by the look of how he's going on. We talked about last week the politics, reform potentially moving in second place. Again, for anyone that's not totally up to speed with UK politics, the Boris Johnson mega landslide victory was done because he did a deal with Farage, who moved away his Brexit supporting people to allow them to vote for Boris on the basis that the Brexit got done, got dragged out. Most of the stuff's not happened, blah, blah, blah. So everyone feels betrayed in the north that voted for the Tories. The Tories are going to get smashed apart from the Remainers and the Brexit split. And to me, the real curveball for the whole thing that no one's really considering is just what happened in the Brexit vote, is that the red wall in the north that voted Brexit may well join the reform if they're still pissed off. So already we've had a YouGov poll at the end of the week that has put reform into second place. So it's probably too late for that absolute cataclysmic result to happen, but don't rule out reform being the second party in the country. I mentioned what Trump is up to. So Bank of Japan, what did they do? Well, we didn't get the rate cut, and it was net stronger rhetoric than what he produced on the day of the rate cut, but still waffly. A sort of commitment to, in the main, stop bond buying after the next meeting in July. I mean, just say yes or no. And he said as long as they can get embedded inflation above 2%, then they'll have room to make another rate rise. Again, no real plans beyond that. So it's just left it open for this strength in the dollar, which obviously, as I was joking, that they'd be throwing their sake at the wall or the fireplace, expecting the Fed to move on the rates to a more dovish stance, and actually FOMC's gone the other way. So that's put a bid back into UJ. It's also put in a temporary short-term high that kind of bakes in future highs unless they do some strong intervention. So didn't get what we wanted. The Bank of England will get CPI the day before they make their decision. They will have met already. In the UK, they meet a couple of times before the week of the meeting, so they'll be prepared already. The one thing that is in the way, if you remember last month, I said the index of services had surprisingly beaten. So when it came to CPI day, we'd still got strength in services. That did correlate as it tends to do. And again, this month that beat. So there's every chance that we only get a small continuing downtrend in UK CPI and the services remain sticky, which will guarantee there's no rate move. But if that services inflation doesn't come through this week, there is, as I've just highlighted, a good chance that you could get the two people to move. SMB, obviously safe haven flows, gives them the chance to potentially use that as an excuse to cut rates. I think Norway are supposed to have a meeting this week as well on Thursday. I don't think they're moving. Janet Yellen and the Treasury got away with what we were talking about, the change in the balance sheet. People, I think, have just decided that it's ruined forever. The more worrying thing about Yellen was her at the weekend jumping up and down saying that the G7 money stealing from the Russians is legal. That's a moot point. We'll see how that plays out with Putin already on the charge. PPI was obviously very, very good on the back of a good CPI, and all the factors that feed PCE, the Fed's actual measure that they watch, fell, which is on the airline side of things and the hospital costs. And we didn't seem to have blowout professional charges in the markets either. So net, it was all okay. The headline was actually negative. That was on oil and energy, which is a bit volatile at the moment. So that may not stay in at the headline level, but the trend back to zero. And we sort of set ourselves up both times looking at that, saying that the bias going into those numbers was for beats to the downside. Hopefully you all understood that with the way that the average and consensus and the median where they actually were relative to what it would take to move, and the fact that we knew there were certain elements due to be soft, that gave us a good setup for those to beat. What we didn't expect was the FOMC to rug us and Europe to do a wobbly. So 10-year, we'll have a look at that again on the charts. That did end up the week down 20 bips on the yields. A bit of yield give up. So the yields were up, the bonds came off again just a little bit. They consolidated that breakout. And then the one that has confused everybody now is the Michigan survey, because that's not just low wages, that's a lot of middle income people. Thank you, Mohammed. I'm glad you enjoyed the analysis. So that Michigan, given all the movements on inflation, you'd have thought that their short-term and 5-year inflation expectations would have fallen, but they actually both sneaked up by 0.1. I looked into detail, and the survey went up right up to the Wednesday, so that did include CPI and the FOMC. So the fact that the FOMC's dot plot went the wrong way obviously fed more than the actual underlying inflation to the man on the street, which means they're pissed off with not getting the rate cuts, and hence the actual consumer sentiment surveys all went to record lows, certainly record lows for the last 25 years, and hence that's another data point that came in disappointingly, and people are starting to take notice of the sentiment, because if sentiment goes down, there's a big correlation to spending stopping, and if the Fed wants to be data dependent, then they're just about to make the economy data dependent. As we said before, be careful what you wish for. Just start normalizing. Just do a cut. Put a cut in there and say that you're stopping and then watching again. Just take away that excess money that high middle income and rich people are getting to reinvest, and take away the pressure from the people at the lower end. Otherwise, you're going to have a nasty surprise, and we're going to be on the back foot 50s and 75s. But all for the wrong reason. Talked about Jean-Luc. Anyone that missed the start, Luc I use as law of unintended consequences. So whenever something stupid happens, like Macron, that's when his French cousin Jean-Luc is involved. Indices, we went through it a lot on Friday. We're still in that situation. Are we actually playing out one and two nesting, or are we still consolidating and one final low to finish off the moves? So a lot of them over the finish to Friday session have got very close to filling the patterns, and it's all about what we do in the next few sessions. The dollar again has gone up to its equal legs high for this little wave 2 consolidation we're looking at, and we need to see whether that continues. And we'll have a look at that at the moment, because that could easily have another finishing wave to take that slightly higher. That will feed through to having more sideways moving, finishing off risk off before it gets flipped to the next high. So we talked about gold, bottoming pattern in blah, blah, blah. Well, I say I will call the top in gold when I can see where the supply is. And until people make me aware of where the physical is physically going to be offered, then the medium term is going to be higher breakouts. We just need to work through these volatile periods of where it gets delivered and where people are going to push it. But outside that, geopolitics obviously is back in the room. Petrodollar agreement gone. G7 poking the bear. Jean-Luc Yellen saying stealing is okay, and Ukraine went on a major tour of some of the Asian countries, trying to drum up support, and India have told them to do one. They want to remain neutral, so they're not getting extra support. Putin's threatening to bomb air bases, and he's sending his Navy craft all around the world just a posture. North Korea is supposedly sending hundreds of missiles and shells over. So all the rhetoric in the background is super negative, but that all seems to be coming at the end of what looks like a consolidation pattern. So this is quite instructive for looking at it technically and saying, well, that a lot of that is in the price. And now we're just seeing kind of repeat headlines. So Julie, thank you. I enjoyed the gold analysis as well. Given what we know, what's happening, could the price we already see reflect any of this? I think the price movements have reflected it, and now the buyers don't necessarily need to buy anymore because the people who are short are going to have to do the hard work. It's how they try and play it. So I think the volatility is going to come from people just trying to bluff out some selling, and that's why the volume's gone a little bit lower because no one's really playing. So as always, we just need to look for extremes, and we need to play things with support levels, stop losses. And if you can find some intraday patterns, great. But at the moment, every time I look at it, it just keeps gapping. Right, let's have a quick look at some charts, then we'll have a quick discussion of the waves. Actually, no, let's do it the other way around. Let's have a quick discussion of some wave patterns. Is that showing? So just take any basic reproduction of the original Elliott text, and you'll get taken through all these things. The motive waves, as we'll show in a minute, that's the direction of action in a wave movement. So that you'll have impulse, which within impulses you'll have extensions. It's all about the different patterns. Anything that is against trend is called a corrective wave. And you hear me talk about zigzags, flats, triangles, and then doubles, that sort of stuff. Something that's quite important once you know which waves you're looking at is alternation. So in a 5-wave move up, when we look at it, you get wave 2 and 4 will be correctives, and they're often the complete opposite wave structure to each other. And that's generally another signal that you're in the right wave because you've spotted that it's doing the opposite of what you've already got labeled as a wave 2. And then over the weeks, we'll go through all this kind of stuff. I can't do it all today because it'll just talk you into the floor. Let's just get, so like I say, basic pattern and that can be up or down, whichever way the primary trend is, you're going to have 5 waves. The action waves are 1, 3, and 5. So their action, because they're motive in the direction of travel. And then 2 and 4 are counter to that trend. They're going in the opposite direction. So we talk about 5 waves up. Now, all of these are fractal. So we talk about waves within waves. They've all got different degrees. So each of these will be made up of, say, the active waves 1, 3, and 5 will have sub-waves of 5s in them. And then within these 2 and 4, they'll be made up of basically three waves, A, Bs and Cs, or WXYs, all various patterns that can develop. So that's when you add a motive phase to a corrective wave, a wave 2, within which it's got an A, B, and C. It's all just the basic stuff. And then this is when you start to get waves within waves and extensions, etc. So you start to see it at a lower degree. So this one here talks about the what's that, intermediate level, 1, 2, 3, 4, 5, which makes up a primary level 1. So that's the highest degree in this picture. The next level down is the single brackets, the intermediates. And then you're playing with the minors. So at the moment, we're in the 5th intermediate wave in gold, and we're currently in this middle 3rd wave. But we're actually in a cycle, the degree higher, in the cycle 1. So at the moment, we're in the very early stages of a big move to finish in gold, but we're in the very early stages of a 3rd wave here, which has gone into extension. So it'd be similar to here, this 3rd wave would be extending. So lots more upside in gold. We just caught very early in the breakout pattern. So this is kind of there are, since it's been originally done, some people have put in some higher degree ones, and there are some really lower degree ones below this. But these are the general ones that the theory talks about. So grand super cycle, we've talked about super cycle in commodities, and we think gold and uranium, etc., are in that, copper. And that's mainly when, from a fundamental point of view, that's when there's lack of supply, or the lack of ability of supply to come on quick enough to meet demand, which is very much where we are in gold. Silver's running out of physical supply. And then below that, you've got a lot more of the sort of, super cycles tend to be multi-decades, and then you're into decades and years and months and weeks, and then we're dealing in days and weeks, and gradually coming down the time frame scale. A lot of them overlap in each other, and that's why you've got waves within waves within waves. And that's why I talked to a couple of guys on our chat who were drawing them, that it starts to get important how you label them so that people can tell where you are. You can basically start off and look, try and find your 5-wave patterns and your 3 waves against it to try and spot what kind of a pattern you're in. But then eventually you need to start working out where you are in the overall structure by moving out on the time frames. And then if you start labeling it properly, people can start to understand where you are, because then that means you're in a different part of particular waves. So you may well be in the minute or minuet levels, but you might only be at the start of the minor pattern, or equally you could be at the start of wave 1 of a minute wave 1, but be in the 5th wave of a minor. So you're getting towards the end of a pattern. So it starts to get important where you are, because you'll start, as we'll have a look at over the next few weeks, you'll start seeing different patterns in certain places. So basic rules on 5 waves, for instance, just the basic rule is that the wave 3 can't come back into wave 1, and wave 4 can never go below the length of wave 3. So that starts to, wave 3 can never be the shortest. That's the primary one. So most of the work gets done in wave 3, but there are various rules that change that. So when you're in waves 1 and wave 5, you can get ending diagonals and leading diagonals, and they're the only time that you generally see overlapping of the wave structure. Normally there is this gap where wave 3 is. So that's when you start to think you're in a different structure, maybe early or late in a move. So that starts to become interesting. And it also means you can have 5 lots of 3 waves. So normally here you've got a 5, 3, 5, 3, 5. That can still occur as a leading diagonal, but often it goes into 5 sets of 3. And the ending diagonal will always be 5 3s. So again, you start to know, if you start seeing overlapping and it's only 3s, you know you're getting quite close to the turning point. So this is all good for understanding what kind of waves you're in. And we'll go into each of those with a practical example over the next few weeks of showing you where they have occurred. What I really want to talk about today, hopefully it's on this one. It's coming up nice somewhere. Well, two things. The alternation, which is what I was talking about. So generally when you get the 5 waves, if you have a sharp decline here that happens, it goes down a long way and it doesn't take very long. When you get to wave 4, you'd expect that to be much narrower as a range trading band and moving sideways, and probably for a lot longer than the wave 2 was. And that can be the opposite way round, and it works both ways, bull and bear. But that gives you clues when you start seeing sideways action or retracement of a big move up. It starts to give you a clue what type of wave it is. And in general, you tend to get the sharper waves as a wave 2, particularly if you get a leading diagonal, which is a bit flatter and a bit wish-washy and overlapping, etc. You'll tend to see people think that isn't necessarily an impulsive breakout, so they tend to take it on. Then if it doesn't break to a new low, you've got this nesting situation, then you'll expect a big breakout. Wave 3, and then you should see the complete opposite. Wave 4s are generally 38 spot 2 as a main. These wave 2s are 61.8 to almost 100 a lot of the time. So that's when you start to look at the fibs overlaying it. So that's the first sort of way of looking at it psychologically. And then this is the one I wanted to look at really. These are the kind of market fundamentals you want to be expecting as you move into a new 5-wave trend. So it says here you'll have bottomed mainly at the higher degree by definition. And if it's been a really big, deep bear market, then you're starting to question existence, survival. There may be wars and depressions. At the intermediate level and the minor level, where we get all the work done, you've got talk of recession, you might be in it. There's panic, looks like it's never going to finish. Some people might be fighting, and there'll be lots of bad news around. So a bit like in October 22, if you're trading the markets then, we've got that really end of the world, it's only going down, and we've got a cathartic sell-off with a big V-shaped recovery, and that was the end of that move, and we've been sort of rallying and consolidating that ever since. So that was an interesting bounce back. People began to think that maybe it's still okay, but a lot of people were describing it as a dead cat bounce sort of thing, so you'd still expect that. So it has to have a retest really, because people don't believe that first breakout. We'll tend to test the lows. So again, this is why you need to expect wave 2s to often be quite a deep pullback. People will start to say, and they're late to the party, they can only see bad news, and they start to tell you that it's worse than it was before. It's just a pause in an underlying downtrend. They won't, it's denial. They won't accept it. But it doesn't actually break to a new low, and you start rallying. So what is happening there? That's when the real money is about to come in and do its work. People have recognised that it's a change in trend. You've had the retest. You've survived it. You all know about that. A lot of you use that in your indicators. Get strength, breadth. The fundamentals are starting to improve. People are making money, and by the end, you're considering that the only way is up. Now, again, because that is never the shortest wave, and it can be the second longest by definition, you generally tend to get most of the work done there, and it often extends. So you'll have a number of impulsive breakouts within that third wave. And again, if you get the third wave within that third wave, and possibly at other degrees, and what I'm always looking for is a kind of 4-degree structure. So wave 3 of a 3 of a 3 of a 3. You know you're going to have some powerful moves. Hello, teacher. Hello. I haven't seen you for a while. Until obviously that gets to a stage where it needs to consolidate. Start to see things diverging. You'll often get the wave divergence coming in. Growth signals might be changing on the fundamentals. it'll pull back, but it will obviously, as we talked about before, shouldn't be entering wave 4. If it is, from what I've told you now, saying, yeah, maybe it's an ending diagonal. But again, you wouldn't be getting a 5 wave really in that. They'd all be sets of 3s. So you're looking for proper disappointment. So people at the moment, we're in this 3, 4, 5, and we've got generally in the indices, but you've got a lot of the bears talking about we're ultimately hitting a 5 of a 5 of a 5 long-term, super long-term, multi-decade highs. Then we're not are we really seeing all that disappointment underneath? But we are starting to get some divergence with only certain parts of the stock market go up. So this is where, as I've been saying, I think we're potentially in a wave 5 of a third wave, which is going to consolidate and then go in and start putting in high degree 5s, because we are getting market outperformance, fundamentals having the main improved, but not for this kind of euphoric coming off the bottom type breakout that we've seen. So it's a slightly different psychology. There's lots of chatter about overvaluation. Now we've kind of seen it off at the moment because the overvaluation isn't there because the earnings trend is up. So a little bit premature on that. But we're about to have some kind of consolidation waves. As we said, by definition, we're in a 5th wave. At some point, that is going to turn round. So things to look out for, and there are certain signs of these in some of the indicators we talked about. Large degrees, there's prosperity and peace seem to be there forever. Well, that's not really the case at the moment. We have had a long bull run, but we've got sort of war breaking out left, right, and centre. Have we got some arrogant complacency in there? Possible. I mean, there's a little bit of complacency that the tech stocks are going up forever. Intermediate degree, economic improvement and a good feeling. Sort of, but it's not completely topped out. We're still getting good news, but it is a mixed picture. We've got a mixed picture out there. We've got people arguing things both ways. So it's very, very symptomatic of being in a sort of top. What we need to see is the trend line's broken. At the moment, we keep seeing all the things that we've got placed in medium-term trend lines are all holding. If you remember, we keep hitting the lower trends and they're bouncing off them. But if it does start breaking down there, then it's a bit like the April the 19th setup. That it looked like we were really, really blowing up, but they put in a 3-wave structure ultimately into what was the bottom. And the reason for that is that breadth started improving. In that sell-off, price decline, were they relentless? There were signs of it, but it started to wane into the second half of that. So we got a bounce within that first wave, which eventually made us realize that it was just a subdivision of the first one. Fundamentals collapsed in response, not necessarily. They've, if anything, picked up, haven't they? And it's been growth. Growth beats everything. It's the interest rate argument that keeps falling away. But it's the wave B that is the one that catches people out, because that looks like you've returned to trend. So when the bear market, first bit of the bear market stops, it looks like you're getting a complete reversal, and that does go quite aggressively up, but it never really gets past 50 to 61 spot 8 fib, and that's where you want to see it get to quite quickly often, and then put in a final C wave where in order for that bear market to take place, this is what technically needs to happen in the weeks ahead, is you get fundamentals weakening, and at the same time you've got this crazy euphoria into the top of the market. So that is a potential setup in the weeks ahead, which is what we've talked about for the wave 5 of wave 5 coming, which I think we're still one consolidation away and another breakout, rather than being this one up and coming. I don't think we've had the tech stocks. They have been going up, but for the right reasons. They keep growing their orders, et cetera, et cetera. We need to see ratios are starting to get silly, and that's not happening. We're not getting necessarily breadth across the way. So what we need is, and we said this the other week, once the breadth comes versus the tech stocks, you'll start to see a proper C wave that will be a very quick and aggressive sell-off, because everything is turning around the wrong way. you'll have the lower weighted stocks taken over from the higher weighted, and we've shown that already last week how that can have a negative effect on the index level. So what we're going to do going forward is building up within each of these waves, looking in the market when we find them and talking about whether we're seeing these sort of psychology bits around the side. And then we'll go into the individual technicals of the setups of how those waves can be made with the zigzags and the flats and all that. But it'll be too much in one go. But I just wanted to have a first go at showing you how those wave structures will start fitting with fundamentals as we go along. So you start to feel like there's a combination of sentiment as well as technical levels and Fibonacci's all in combination that start to make things look a little bit more sense in total, which is why we need to cover the fundamentals and see where the biases are. That's why I think Elliott is useful, because you can combine the two, and that's how we're going to continue sort of building the picture up. And then hopefully that makes you all have lots of questions as to how that's happening. So let's quickly run through the charts I put in the daily and see how they've moved. So was that useful? Does that bring up any other questions for Friday? So on the Dow, again, we've been talking this first wave, if it is a valid for it. So if we've got the fourth wave in place, which is still a potential because it's not been taken out, then the structure, loads of three waves in a leading diagonal, 5 lots of it to put in this one high, broke out of the converging diagonal structure. So we said we thought we were in a consolidation wave. We had the curveball of a new high, but remember we said that could be an expanding flat. That's one of the structures we'll talk about. We've mentioned it a number of times. That's one of the few occasions when you get an overthrow. When you wouldn't get that structure is if this was a wave 5. It would be something different. You don't get overthrows at the end of a 5-wave move. It would mean that you've got a different structure in place and a new HH, high. As it is, that's a valid structure. It's all a case of, is this here into Friday's low? Is that the 5 waves you wanted? Again, I didn't mention, whenever you have a C wave, the third wave of a consolidation, that always ends in a 5, whatever the working degree is. So in this case, the working C wave potentially has had 5 waves, so that is a valid ending point. Or it could be just having 3, doing a 4, and we need an ultimate 1, a further low. We were looking for this 1 spot 618 sort of level to hold, and also that would hold the previous wave 4. So we're in a sort of no man's land. That gives us a stop loss of the current low, or we carry on breaking out. So what you want to wait for? Do you want to wait to see if it holds, or do you want to see if it takes out a substructure new high? So it's highly likely if that breaks, then we are into a wave 3. Ultimately, we need to take out the B high. So we've got a couple of 2 or 3 signals in there that we need to be aware of as it develops. But it's a very mixed picture again today, isn't it? We're not getting a lot of direction yet. S&P 500, as we said, super low volume. The internal metrics aren't really helping. The stocks above 200-day moving average have collapsed. 50 days still around just below 50% now, isn't it? It's at 43. So this is when you talk about, are you getting a new high versus internal divergence? Similar to when we look at MACDs and RSI. These are oscillators and advanced decline ideas. So it's not a strong breakout. That to me, just from experience, suggests that we're not far off having a decent consolidation at some point. So there's every chance that we are very, very close to this fifth wave and being the top of a third, in which case we get, a decent pullback. One thing that we will discuss over weeks to come is that fourth waves also tend to go back down to fourth waves of one lower degree. So anywhere between this red 4 and the minuet 4. So, as I said, that implication is that we're not far off a decent pullback. We talked about it on Friday. So how much more upside in the S&P do you want to play versus finding what will be a pullback to buy? Because I don't think this is a fifth of a fifth. I think it's the end of a middle structure, and that fits with this July, June to August continued breakout. That doesn't mean it's a straight line. We've already had some performance in June. We'll have some sell-off, and then we'll ultimately go back to finishing the whole period in the blue, I think. So again, looking at it on the 2-hour basis with the long-term trend channel in place, that has been working out quite well. I know I've seen some bears draw that with that being a touch off of their trend channel. I don't, as I just said, I think there's still possibly more upside in this, but it's going to be very, very short. It could almost, this wave, substructure wave 2 could be in place here, in which case, we're about to break out. We've talked before about expecting shorter breakout. So it could be a shorter 3 with an even shorter 5 that touches off this trend line before we put in that consolidation. Had a huge gap on Wednesday that sort of started to fill in. That's a very, very weak low there, isn't it? That might be retested. Well, that might well be the signal there that we bounce off that fair value gap there. Surprisingly enough, the Nasdaq 100 is in a similar setup to S&P 500. They've both been controlled by the movements in the tech stocks, so you'd kind of expect that. Again, last week we were saying that looked like it needed another jump up to put 5 waves in. The argument here is that the fifth, or is this a substructure 3, 4, and that was the fifth? I think for the moment we'll stick with that being the 3 and 4, and we're just doing substructures until we put in the minute 5 of that -3, and the 38 pullback from there before we eventually finish it against the trend channel. Either that 3 or the 5 surely is a 20,000 print just because we're so close. I think it's kind of one of those multi-generational things that wants to happen. Feels like it's in the makings. So expect that and look out for the pullback. Once that 5 is in place, that is potentially the end of this intermediate wave, this primary wave 3 up, in which case we're looking for a deep pullback that sits with the breadth idea we're talking about. This index particularly will suffer when the tech stocks consolidate. We know all 3 of them are over 3 trillion in market cap. They're mega movers for the index. So any kind of consolidation, 5 to 10% is not necessarily a crash. It's just a factor of how heavy weighted the big techs are. And there's obviously a few more there that will make the overall movements look quite scary. But that, we know how Nasdaq moves, and that again should be a pullback of between 5 and 10% and somewhere near the bottom of the trend channel before we carry on and put in the 5th primary wave. Then that will be a significant cycle top. Possibly either this or the next one, which is either going to be August or around the election time, is when we probably really consolidate. We've done gold, the dollar. Oops. Dollar we talked about. It's all a case of, is this a double correction to make the two, which is a kind of WXY situation now because there's substretch to it, or the fact that it's much cleaner as a 5 waves. Here, this may well be a 5-wave finish for the C leg, and we've only put in 1, 2, 3 to Friday's high. We're consolidating, and then we need to put in a final high around 106. And again, that overall structure is going to be within the termination point, which we discussed. We don't want to go above that 106.6 anywhere in here for either a full 5 waves or for the double, which here is valid as doing the equal legs. The dollar may have topped. There might just be one more little risk off event, which could put in the current little extensions to the indices and the gold, which we were talking about earlier, or it's already had a 1 move down and it's consolidating and starting to break. So again, if you're playing dollar currencies, you know where that kind of stop loss area is. It is what, 1/3% away, basically. Our friend Nikkei 225. Again, we had the leading diagonal. We sold off. I think we've put in another 1 high because we've had 5 overlapping waves without the third being the smallest. And we've now put in what looks like a double correction to the 1.236 level of its substructure. So it's gone to the equal legs and just beyond and start to bounce. Again, this final leg, if that's an ABC, you're looking for 5 waves down in there. There's an argument that there might only be 3 within that, and it might need 1 more tiny sell-off. Again, that leaves us with, you can buy with current low as a stop loss or wait till we get down there and see how it reacts and possibly catch the bottom properly. But that has, again, behaved just how we said it would and has hit the buy region overnight. Our good old friend, the DAX, that's teasing us a lot because, again, we had a lower low, which is subsequently held on every sell-off so far. And today's sell-off is a 3-wave at the moment. So it does still sit with having bottomed at Friday's low, which we've been looking for. There are arguments that it's, if that is an ABC substructure, has it done 5 for this movement, or is it completely a 5-wave move? There's more chance of that being a 1 consolidation, a 3 small consolidation, tiny low 5 for the end of the move and a bounce, rather than that necessarily needing to do 5 waves. That would create something much deeper, I think. Again, it's a solid buy with Friday's low as a stop loss, but be careful when we're down there, just how it reacts. Don't extend your stop losses, not that you necessarily should be doing, but take it as it is and see how it reacts once we get there. But at the moment, we've had a lower low that's held on retest, and it's now, can we break out to new highs? Needs a little bit of support from somewhere else. It's meandering sideways. Talks about a dollar potentially has 1 more high that could potentially put in 1 more low. Again, we're in this whole ABC structure, of which There's 5 subwaves, clear 5 subwaves here for a 1, a 3-wave for a 2, and again here, 5 waves down for 3. If that is doing a 3-wave consolidation, we'd expect 5 very small waves here to put in a 5th wave, which again can't be longer than this 3rd wave here. So we're expecting quite a small setup for that to be a valid ABC with a valid finishing 5 waves for the C. The euro looks quite good. So that is almost it's almost a buy with a stop loss there, and then we're looking to buy it again, even if it does break. So 106.5 level is probably where it's going. Play that with as you will. Obviously, there's potential for data and headlines on dollar strength just to move that down, and then we should be into a breakout substructure, 3rd wave, minuet wave, back onto this 110 thing. So we've got lots and lots of talking heads in Euroland really pushing hard back on any further rate cuts in the moment, and they're not going to move until the US does now for the second one, unless things go down the pan. Sterling yen, I mean, obviously the yen is under pressure still. Sterling, it's probably a buy unless we do get the surprise rate cut. So with sterling, I'm still slightly wary. I'll have a look at sterling yen on my chat and for Friday, if you don't mind. So I'm conscious we're getting close to the end of the sesh. FTSE, another one that's been in the ABC extensions and WXY. Got the lower low on Friday session, so that again, as long as it holds, and it has done so far, could be breakouts. It's worth having a stop loss buy potentially for just like, you know, the DAX and Nikkei, etc. for 5th wave breakout. This one, the pattern is slightly clearer, although you would prefer for that Y leg and the C leg within it to be no, we have got it. It's okay. We've got 1 there. There's a 3 and then a smaller 5th wave. So it is a valid ending structure there. It's just whether it wants to make the ending structure look like a complicated extension. We've got 2 places to look to buy or stop loss. And obviously one is the recent low or the equal legs. If it breaks the equal legs, it's probably done. So stop loss and then don't come back until it's broken the equal legs. And we found out exactly what's going on. But FTSE, if it does that, I talked about it. That's my dream entry scenario down there. So it's bound not to happen. I've mentioned a number of times about if we were really an angsty period, we'd expect the VIX to be up towards 1820 and the bond index to be doing something other than just range trading in here. Obviously, we had a couple of extremes as we were flying up. That tends to suggest that we were in the most active part of those bullish phases, and we're definitely in some form of choppy consolidation since. Now it's all a case of, are we going to see new lows for the move index and the VIX just to confirm the last breakouts? And the last one, as promised, was just the structure of the T-bond 10-year future, very much nesting. So these intermediate 1, 2, minor 1, 2 all look healthy. Then we got that new high, got 5 subwaves in to put in the minute 1. So at the moment, we look like we've almost done an equal legs, which could count as the wave 2, or it may be the A leg of a 3-wave, ideally to touch over here around 110. So we might have a little rally from here and then another sell-off. That'll be a 3-wave and then potentially 5 waves there. So keep an eye on some choppy trading in the bonds. And then once that starts rallying, we're into a third of a third of a third. So again, we start to get excited. That's why the gradient of the channel has changed. And then that hopefully is on the back of some falling yields and some breakout on the indices, and hopefully gold going absolutely banzai. So Babu, I will come back to you on Friday, or if you come onto the chat with your ideas, we can talk through it. But unless there's any other questions about anything I've talked about, we'll end the session there. Did that chart come through, or have we had that sharing problem again? Have you been seeing the charts? Because one thing keeps showing me that you are seeing them, and one thing not. Brilliant. Thank you, Vivi. So any other comments, chats, ideas, anything you want to look at on Friday? If not, be careful out there. And obviously, we've got some good idea on the fundamentals on most things. Anything that you don't understand, jump on my chat and start a dialogue. Someone will answer you, and I'll get to you as soon as possible. So if not, then I will end it there. Thank you very much for taking part, and we'll see you soon. Take care.